Hi folks, this is Sean Hyman from Chart of the Day, and I just wanted to build upon a theme that we had been building on for the last couple of days or so to kind of help you put some pieces of the puzzle together. Um, if you'll remember in one of our last videos, we talked about how to spot trends from across the room, and we talked about having your major moving averages lined up and in the proper order, heading in the right direction, and look for the pair that had the clearest daily trend out there. Here's one such trend. Again, this isn't for timing purposes or to take a trade on right now because you'll be seeing this later on. But it pick up the principle and the spirit of what I'm about to tell you. Um, so you've got this headed down here. All your moving averages lined up. You have a pullback towards your moving average, and about that time, you can look to a smaller time frame. This move up and then downward is this on the hourly chart. So here we got a daily chart, here we got an hourly chart of Euro Aussie, EUR/AUD. This move up and then this move down is this spike upward and this spike downward. Um, an hourly 30-day chart, if you're wondering what that is on the daily chart, count back 30 daily candles, and that's exactly what you'll see on the hourly 30-day chart. All you'll have is this is chopped up into smaller bits. Now, so if we're looking for shorting opportunities because the trend's down and we've seen a pull, a move upward towards the moving average, so we've seen the pullback in the downtrend, which is actually a run up in the downtrend, and we're ready for see the downtrend resume again. What we'll want to do is we can zoom in on the hourly or 4-hour chart. So um, so if we wanted to look for shorting opportunities, we could use something like the slow stochastics here. I have a 14.33 setting on the slow stochastics. That's 14.33. Again, this is not a magic setting. This is just a commonly used setting. And so what you would want to do is you would want to enter when the lines come up, cross, and come below the upper overbought level. So that would be here on the chart, that would be here on the chart, that would be here on the chart. Any of those are overbought levels. That would be back here on the chart. It doesn't guarantee that you're getting the absolute highest point, so you still need your stops way up here to give it some breathing room. What it does tell you is that you're in a short-term overbought condition in a longer-term downtrend, and that gives you a high probability trade. And that's what we need in trading. There is nothing that will tell us 100% yes, this will be a winner before we get into it. And pros know that they will not win every trade. Winning every trade is not what's required for success in trading. What you need is an edge and good risk and money management. So your edge is following with the trend and entering at a specific overbought point, since this is in a downtrend. And you'll see that many times when these start moving downward, you can take and move your stop down to protect profits. You can pull off some of your lots to protect profits. That way, in case it comes back and hits your stop, again, you can hop in it again and take it down as well. So this is like a 100 pip move here. This is well over a 100 pip move here. This is about a 100 pip move here. It's a fairly volatile pair. So you can take these shorter term moves in it, or you can go out to the 4-hour chart and look for longer moves that you would be in for longer periods of time. This is a 4-hour 40-day chart. So a 4-hour 40-day chart is the same as the last 40 daily candles counting back. So again, this move that you see that comes up, corrects a little bit, spikes high and then sells off, is this move right here. Comes up, corrects a little bit, spikes high and then sells off. So if we want to zoom in on it a little bit, again, we're just using our 14.33 stochastics. We can look for overbought points to where these lines come up, cross over. That's your sell signal, and then you look to get enter. You look to enter when it crosses back out of the overbought territory. So right in here, so it'd be right in here on this one. It would cross, and then it finally works its way down to being out of the oversold area, overbought area rather, right in here. So again, you would be in it as soon as it started moving down in your favor, and this would be about 200 pips of movement here, you would want to move your stop down once it got about 100, 75 or 100 pips or so in the money, meaning profitable on it. You would want to start moving your stop to where you removed your risk and you protected profits. That way, if you get a snapback, you preserve some profits and you make 50, 75 or 100 pips out of that move. Again, when it goes oversold again and crosses down below, you're in it in here somewhere. Again, stops need to be wide, way back here. Use a light number of lots per your account balance size. And I typically suggest about one lot every $5,000 in your account for a mini lot, one mini lot per $5,000 in the account, or one micro lot per $500 in your account to be traded. Keep those stops wide. A lot of times I put them back above a previous high. So we get into the trade right in here. It does recoil a little bit on us, and then it starts descending like we think. As it starts moving in our favor, we move our stop up or down, which is moving it into the profit. In other words, we're protecting and ensuring some profits on the trade. This one does not recoil enough to come back and stop out any, so the trade can keep going and so forth. So, in this trade, there would be about a 250 or so pip gain. So that's combining your daily trend direction as shown by the moving averages. Remember, we flip through our charts to find the best looking pair, maybe the best top 2 or 3 pairs, and then we look to our smaller time frame to look for signals that are overbought and oversold. Let me give you a quick example of an uptrend. This is Aussie CAD on the daily. It's got its moving averages headed right. It's looked like it's trying to turn around, so we can move to Aussie CAD here. Again, this is our 4-hour chart. We crossed over, we headed up here, so you would be in somewhere around in here, and the pair headed higher. The last time it crosses, it heads about here. You're in probably about right here. It heads higher, pulls back some, and then it heads higher again. If you want to more short-term trade this, you could be to the hourlies, and every time it hits an hourly crossover and then heads higher above these lines, we can look to buy. Again, we can buy anywhere in these overbought areas, which would have been right around in here, and then our final one here, which would have been right around in here. The newer you are, the less familiar you are with trading. I would encourage you probably to stick with some of the longer term moves, because the more pips you get per signal, which is what you get on signals on a longer term chart like a 4-hour chart, the more chances that you can make more money, and if your entry's sloppy, you still have more pips ahead of you. You can capture more pips of the move, that sort of thing. So, the longer you can stand to stay in it, the better off you typically are, and that's going to be seen off of the 4-hour signals versus the 1-hour signals. If you're a little bit more experienced and you're, I wouldn't say a day trader, but you're a semi-shorter term trader, then you can take these signals that come up on the hourly chart. So that is your chart of the day. Thanks so much for watching. Bye-bye.